All right, Bill. I had a bull put credit spread on Netflix that went down on high volume the past 3 days when it was hovering around my short strike. Got the deer in the headlights moment with this freight train coming barreling down on me. Believe me, I've been there, I've done that. I was pondering whether to cut my losses or wait out and hope the big money slammed on the brakes. But considering the train's massive momentum, I went ahead, jumped off the tracks for a loss, one that far exceeded my initial net credit. Naturally, when you take a loss, it's going to exceed it, but usually, in a credit spread, especially this type of one, we're going to take a look at it exactly in just a moment. But in this case, he says, so fortunately, the wound is not life-threatening, but I'm left wondering if there would have been an alternative to bailing at the last moment. Okay. Well, and he told me here's the trade. On September 11th, Netflix was at 444.21. We sold the 6th of October 395 put and bought the 6th of October 390 put. But I don't have any premiums on this. So what we had to do is we had to go ahead, jump ahead here, and we had to use the historical chain on Power Options, looked up what the closing prices were for September 11th, 2023, of course. Around your price, Netflix was at 445.36. Pretty close. I gave a few pennies here and there. The real midpoint price for selling to open the 6th of October 395 put with a stock at 445.36 was 149. We're going to give it to 150 when the stock was at 444.21. Okay. And buy to open the 6th of October 390 put was about at 117 or so, but we put it at 120 if the stock was down there around 444. Okay. Couple cents here and there, but what we might have gotten at the closing prices, a 30-cent net credit on this 5-point spread, which means our maximum risk was 470. So we're looking at a 6.4% return for, again, roughly 21 days out in time. Same expiration that we had for Octavio's question just a moment ago. But with the stock at 445.36 on the close of September 11th, the probability that Netflix would be above 395 was 89.7%. Now, the stock price right now is at 396.69. I should say that at about 3:45 p.m. when I was putting together the slides for this discussion, Bill, it was at 396.69. Dropped 380 down today as well. Okay, so this is the position we had. 30-cent net credit on a 5-point spread, potential 6.4% return with an 89.7% probability above the short put strike price based on the historical data at the close on September 11th. Now, I am not on the right slide. There we go. First, let's review my general rules. They don't have to be your rules, but my general rules for stops. And we've reviewed this a few times on the different webinars. They're on YouTube. They're in that bull put playlist as well. You had mentioned the wound is not life-threatening, but I am left wondering if there would have been an alternative to bailing at the last moment. Whenever I enter a position, bull put credit spread into the portfolio, I'm going to put in sort of my stops on the position. The 1% rule. If the stock reaches within 1% of my short put strike price, we sold the 395 strike, 1% would be $3.95. So I'd put an alert in the Power Options portfolio to notify me if Netflix drops to 398.95. This would have triggered likely this morning if it didn't trigger last night, but I think it would have triggered this morning. If the loss is 50% of the total maximum loss, remember the maximum loss in the position was $4.70. So if my liquidation loss to close out the position is $2.35, half of the maximum loss I could take on the position, I'm likely bailing out of the trade right there. The 1% rule is not a defined stop for me. It is saying, hey, this isn't doing what you expected it to do. You might want to consider some adjustments real quick. Okay? But that 50% rule, I will typically stop the position right away. I will close out of it, take my 50% loss. I'm going to illustrate why a little bit later in this discussion. Now, if any technicals you use to enter the trade reverse, so I might prefer to use the MACD. My default bull put credit spread screen, I'm looking for stocks that currently have a positive MACD of at least 3 days. And you might also look for Bollinger Bands. You might use RSI. You might use Fibonacci or anything along those lines. But anything that you use to get into a trade, you want to try to find a way to set an alert or watch it, because if those trends reverse, think of it as a new trade. Would you open a bull put credit spread on this stock, seeing that now the MACD is negative, the Bollinger Bands are breaking to the lower side, the RSI is not where you want it, or the Fibonacci is not where you need it to enter in a bullish trade? Look at it as a new stock, not your position. If that stock is not something you'd enter as a bullish trade, you might want to consider exiting your position right now, because it's not doing what you expected it to do. Unfortunately, that happens. But let's take a look at the Netflix chart. Right away in this trade, 2 of the 3 triggers that I might use to exit the position were hit. I didn't go through the whole historical analysis to see where the 50% loss was triggered. My guess, Bill, is that it would have been somewhere around here, where I would have been a loss at 235, maybe even here. So I might have actually closed the position here. I don't know if your loss was more than that when you liquidated this position. We'll take a look at where the position stands in just a moment. But again, if I open this trade, I would have found it. I'm going to see if this trade was on there too. So I got to do 3 things here, and I'm going to try to figure out the best order. First one's that, and then okay, those are the first 2. Okay, sorry. Something I just jogged my memory that I should think we should include in this presentation that I didn't have included in the slides. We're going to take a look at his power options. Let's get back on track. Trade opens September 11th. Right here, as Bill mentioned, stocks trading around that 444.21, 445 at the close. Now, the next day, so what am I looking at here? The stock's trading just above the 20-day moving average. Maybe not enough for me, but it's there. The MACD is positive. The MACD is above the EMA line, but it's not above the divergence line. That's not really a key for me, but it's something I might have considered when analyzing the trades that met the search. One day in now, the stock now drops below the 20-day moving average, and just even later that day is where we start to get the negative MACD crossover. So 2 of the 3 technicals I used have been triggered, showing me that this stock is starting to move in the wrong direction. And it opens up and gets worse. And this starts to get worse. And again, as I mentioned, probably right in here when I was at the 50% rule. If I hadn't gotten out here, which I might not have, because we're still hovering at 430. We've got a 395 strike. We've got 20 days to go. It's still okay. But right at this range, even though I'm not at the 1% rule, if the 50% loss is triggered, 2/3 of my technicals that I would have used to get in the position are triggered, that's enough for me. I'm out. I don't want to take anything more than that 50% loss if possible. But I don't hit the 1% rule until here, where the loss would have been bigger earlier this morning. So not at yesterday's close. We were still hovering around 400 or so. Remember, that would have been 398.95, but it dipped a little bit below 400 here, right? A little bit below 400 there. But yeah, just shortly after that, we're definitely in the 1% rule. And I would have considered just liquidating a position as you did to take the 50% loss on the trade. What other things could have been done? All right. Well, as you know, we've got many webinars. One of our popular webinars is 8 ways to manage a bull put credit spread. We also have 8 ways to manage a bear call credit spread, 7 ways to manage a debit spread, 8 ways to manage a losing long call, 8 ways to manage a winning long call. I think it's just 8 ways to manage a long call. I don't think it's 8 apiece. But the 8 ways that we prefer to look at managing a bull put credit spread is, number 1, do nothing. Number 2, what Bill did, liquidate, take the loss, keep the loss to where it's not, as he mentioned, life-threatening, but it's still a loss. No one likes to do that. And number 3, roll the short only. I've got a spread position. I've sold a 395. I've bought a 390. Maybe I still think this is just an aberration. As you said, maybe the big money is going to come back in. Maybe I can just roll down, especially since the beginning of the trade, from the 395 to the 392.5. And still keep a positive net credit on the position, but give myself a little bit more breathing room. Roll out the whole spread, of course. That's a popular position that everyone says, hey, don't worry about it. Just close your spread, move it down in strikes, and move it further out in time. You'll get a net credit. What do I have to do? Go 4 months, 5 months out in time to make back that $150, $2, $230 I lost? Do I have to go to wider strike prices or increase the contract size, excuse me, which is drastically going to increase the risk? It's not always the best approach, believe me. 5, create a condor. Open a bear call credit spread on the upper end of that position. Give you a little bit more net credit, which it does what? It lowers the break even on that farther side. You get a better break even on the lower side, but now you also have 2 ways to lose. If the stock recovers as you expect, you can lose on the bear call side where the bull put would have been safe to begin with. Close and do the opposite. Close your bull put credit spread for a loss, and instead of just rolling out the spread and trying to continue a bullish position on a stock that's going against you and showing bearish trend, do a bear put debit spread. But again, you might have to go 3 to 4 months out in time, increase the strike differences, or increase the number of contracts to hopefully make back the loss that you took. Number 7, close the short only. I'm in a bull put credit spread. Stock starts moving against me. I fear that it's going to continue to move down in price. It might be expensive, but if I buy to close the short here, you liquidated and took some profit out of this option to counter the loss here. But if I just close the short, now I'm left with a long put position where my debit, my cost for the long put, bearish strategy, is the buyback cost of this option minus the net credit. And if it continues to move down, I could see good profits on the trade. Or the pendulum adjustment. That's with one move converting your bull put credit spread to a bear put debit spread. It's something I really like to use. But would any of these been the right thing to do? Well, that's tough to answer. Is one better than the other? Well, it's tough to say because we don't know the future. But these all come with caveats. As I mentioned, do nothing. Number 1, hold and hope. Hope that the stock doesn't breach 395 and it continues to move up. Now, we are seeing a little flare here of a positive MACD. I took the volume out, but it did show a decrease in volume and then an increase up the past couple of days. It's too short of a time frame here. But again, it might settle and move back up. We didn't breach 395, but we did breach the 1% rule. We got really close to that. Liquidate, take the loss. This is what Bill did. And I feel it near the right time. Again, I might have closed it up here if it was at that 50% loss. It might recover and still be profitable. But if it continues down, whatever loss you took might be greater. Roll the short only. This wasn't an option. There's only 5-point strike differences. And remember, on our spread, we were in the 395, 390. So I would have maybe moved the 395 down to 392.50. There is no 392.50. Okay, it's only 5-point spreads. This was not an option for you. Roll out the entire spread. Again, possible. But we're showing kind of a bearish trend here. Do I want to move to another bull put spread another 15 to 20 days out in time? If I took a $2 loss, remember, you only took 30 cents on this initial net credit. So if you've got to make back the $2 loss or $1.50 loss you paid into it, that means you're either taking a much lower probability trade. To get the monetary 150 back, you either have to increase the number of contracts or increase the strike difference. Instead of a 5-point spread, go to a 10 or 15-point spread, which means more margin requirement, which means greater chance for a greater loss if the stock continues to move against you. This is a hard one to do, especially on a stock where you don't have a positive direction. You thought it was positive, it looked good technically, and then it just changed. Now you don't have good, hey, I was debating this, do I close it, do I do this? You know it's better for me just to get out because you didn't have a strong sentiment that it was going to recover or that it was going to continue down. You got out of the way of train tracks. I can't fault that. It's likely, as I mentioned, what I would have done. Creating the condor, okay? So we've got our bull put credit spread, and the stock's now down to 395-ish. So what might I do here? I might create a condor by on October 6th, selling, let's say, the 405 and buying the 410. Calls. I do a bear call credit spread. I complete the iron condor. Okay, so this might give me another 40, 50, 80 cents. That gives me a little bit better break even. but it didn't solve the problem of what's losing. That's why I don't really like this one too much, because I might lose less. My max loss might drop down to 390, but I could still lose that 390 if the stock continues down. I've done nothing to stop this bleeding on this side other than that little net credit I collected by creating the iron condor. Or if we were right and it does recover and starts to move back up because we didn't have a strong sentiment, I can now lose on this side of the iron condor where the bull put would have been the winning trade. Okay, so this is what we did. Could have done this. This wasn't available. You've turned my pros and cons here. This is not a favorite of mine because it doesn't address the loss. Close and do the opposite. That's similar to this one in my opinion. But you have to have a defined bearish sentiment. I liquidate the bull put, and instead of just rolling to another lower bull put credit spread further out in time, I create a bear put or a bear call credit spread further out in time, where again, I might have to increase the number of contracts or increase the strike difference in order to get that $1.50 or $2 that I lost on the trade. You didn't seem to have a defined bearish sentiment or bullish sentiment. So this is possible, but what's the future hold? How much would you have had to done to increase the risk on this by increasing the strike differences or increasing the number of contracts? And is that worth it, the risk to take with a position you don't have now a defined direction? Close the short only would have been a possibility. But again, it depends on cost. Because remember now, what we're doing is we're taking that bull put credit spread, closing our short to give us a long put option that might have a very low break even because of the buyback cost of the short put now that the stock's trading right at the money with 21 days to go, Bill. That's a complicated one. But it would be a possibility if and only if you have that defined bearish sentiment. Because what happens here? Your risk was originally $4.70. What happens if it costs you $12 to buy back this short put? You now have a long put that's worth $11.70. If the stock goes back up and this put starts going to zero, you're risking 2.5 times as much on that long put than you originally set for the maximum loss in the bull put credit spread, which again, as I emphasized, I would take the full loss on it now. I mean, I would stop it at 50%. You know what I meant. Sorry, I don't want to take the full loss. I want to keep it at 50% when that was triggered. And then the pendulum adjustment, which is essentially just, it's very similar to this, closing and doing the opposite. Works best when the stock is between the strike prices. I'm going to sell to close my 390 put and buy to open a 400. So in just one move, keeping the same expiration, if the math works out, I've turned my bull put into a bear put debit by swinging this over like a pendulum. And now as long as the stock stays below 395, or in this case continues below 395, then I have the profit on the bear put debit spread. But that wasn't an option. So were there options? Yes. Does it come with the pros and cons that I don't think you're necessarily willing to take or you needed more of a defined sentiment to do? Yes. So I think that you did the right thing. We never like to liquidate and take a loss. You could have also done nothing. Hold and hope. Maybe it works out. Maybe you could re-enter this spread later at different strike prices if Netflix starts to show you a better sort of starts to move back above the 20-day moving average. The MACD goes positive in this case. Maybe you could re-enter something like the 380, 385, something along those lines, okay? But that was a possibility to do nothing. You know the outcomes and the risks of doing that. Didn't have the opportunity to roll the short. You could roll out the spread, but again, how far? And this also goes to this point. You didn't seem to have a defined bullish or bearish sentiment. Why am I going to just simply roll down to try to defend this loss on this one trade on this stock that I no longer have a defined bullish or bearish sentiment on? No, I'll take the loss. I'll look for spreads using my search tool on Power Options that match my criteria that are going the direction I want, not try to keep managing by rolling and rolling bull or bear spreads where I don't have a defined sentiment in my head or a good feeling of where the stock is going. I'll make that up on other trades later rather than try to keep forcing this one to a win on this particular stock because it went against me when I thought everything looked right. That's why I particularly don't like that one. Talked about the condor, increasing the contracts, close into the opposite. Yeah, you needed that defined sentiment, and the pendulum wasn't there. So honestly, I hate to say it. These two, I think, were the best choices in your situation, and I think you took the best choice for what risk you were willing to take on the trade. Where is the trade now? That's always a good thing to look at, isn't it? We talk about this and say, hey, okay, well, these are the numbers. This is what we have, of course, here. Was one better than the other? Those kind of sentiments and whatnot. But at the end of the day, we just got to take a look. And yeah, I know we're at 5:30, but we still got a couple questions we're going to answer. Don't worry, we're going to stay on the line. But let's run some possibilities and power options. Let's take a look at that Netflix trade, where it stands right now. Run a few examples of what could have been done differently, but what might that have done? You can already see that. We've already shown that. So let me pause the screen, folks. I apologize. Let's get back to power options here. Perfect. They're still in our short strangle screen. I'm going to go to the portfolios there. And there's our Netflix position. See, it's not at the 50% loss right now. It would cost me $215 to liquidate the trade, and we're still at $396.94. I'm below my 1% rule. We have not breached $395 yet, and I stress yet. Close to the buyback cost on the short put. I think I said 1170. Well, we're looking at 1023. So we'll take a look at how that would appear also. But again, we're at 185 in this case, and our maximum risk was 470. And I said I'd stop it at 235. If the total, it's 215 buyback, but the total liquidation loss is only 185. So I'm not at the 50% yet, but I did hit my 1% rule. So I likely would have looked to manage or adjusted this position at that time. All right. So power options show me any rollout opportunities. Let's take a look. Let's go to position actions and then position analysis. Here's our position here. Max risk of 470. Current liquidation loss at midpoint's 185. At market, it's 225. It's damn near my 50% loss, isn't it? But I'm going to target the midpoint at all costs if I can. But yeah, it's knowing that the 225's at market, that's setting off alarm bells in my head if I haven't closed this position already. And still, yeah, right on the knocking at the door, 396.94. So if it stays there, this is not a projection, of course, but if it stays there, then you'd keep the 30 cents. One good probability, 85 or greater than probability comes up. Net credit of only 21 cents with the 445, 450 call. Okay, because it's looking for something, I think it's at least an 85% probability. So here's a rollout opportunity for a condor that the system found based on some of the defaults. Let's go to simulate trade, take a look at that. Comparison of where we are now to the new iron condor. We dropped the risk down to 449. We increase our net credit up to 51 cents. But again, now we have two ways to lose. And what haven't we addressed? If it continues to move down, we still take that 450 loss. That's still a possibility. We took a little bit of a net credit. Sure, there might be other spreads, other strikes you could use. This one's just based on that conservative 85, 80% probability on the condor against this existing bull put. So that's the one. But what do you see right here that stands out? Doesn't do anything to address losses that still could be taken on the bull put side. It just gives you a little buffer. And you could get a little bit more buffer naturally by using other strikes. That is absolutely true. Get more net credit here. But then it still puts you at two ways to lose if the stock goes back to where it initially was when you entered the trade 5 days ago. That's also something to consider. But there's a rollout opportunity shown. Just not a fan of it right now. Don't think that's giving me enough bang for the buck to do it. It's not giving me enough luster on that lower break even to really feel that it's worth it for me. Okay, so I didn't see any other ones here. Let's go to what if calculations. What does that do? That takes us to the profit and loss chart. Using the premiums, your premiums, again, Bill, might have been different. We know we're looking at that 30-cent net credit on that 470 risk with a 6.4%. Now, if I'm bearish on the position, just buying back that 395 option for about 1087, I think we said 1023. Let's see here. It is. Oh, I'm sorry. It's a little bit less than that. It's 1025 at midpoint. So let's just simulate buying one. Now the tool is not reading this necessarily that I'm buying to close this call or this put, excuse me, but mathematically and graphically it's going to come out the same. So there's my long put position now on Netflix. This is just buying the short only. For 21 days, I'd have a cost of $992.50. Let's call it $993 for, what am I left with? A $390 long put with a stock at $396. It's been declining. Lower break evens at $380.08. That's break even in 21 days, right? You'd have to have a strong bearish sentiment, as I mentioned, for this to work to your benefit. Could it work to your benefit? Absolutely. But you need a big move in 21 days. So I don't think this was necessarily the best play unless you had that strong bearish sentiment. As we saw, if we liquidated the position right now, we're taking a liquidation loss of 185. Let's just clear this out. Why is that important? Well, let's say that I did roll out to November, 63 days away. I wanted to keep with bull puts, but what do I need? I need a minimum $1.85 net credit. I'm not seeing any right away unless I do what? Unless I increase the strike price. See, this here is 10 to 9. We're looking about $1.10, $1.20. 5-point strikes are all about $1.10, $1.20. I need $1.85. So I need to go to something like the 355, 345. So I close, take the 185 loss. I roll down to this now 10-point bull put credit spread, but out to November, which is 63 days away. Oh, I'm sorry, it was only $1.40. I thought it was $1. See, now I'm not even there. I need to make back the $1.85. I really wanted about a net credit of $2.15 to kind of keep that 30 cents you were initially looking for. I'm going to have to go to a 15-point spread. But this is out to November. This is 63 days away. What is likely coming between now and November expiration? Earnings, October 17th. I really don't want to go past the 17th with rolling to a new spread or closing and doing the opposite of a bear call spread or turning it into a bear put debit spread, because the earnings is a coin flip. I don't know what's going to happen. It could brace 20 points one direction or the other. That's probably why I chose the 6th of October to begin with, because you avoided this earnings play. But the stock still pulled back and it went against you. That's the other thing you have to check when you talk about these 8 ways to manage a position. Oh, I'm just going to roll my spread out. How far down do you have to go to feel safe? Even if 340, 350, what if this drops 10%, drops 36 points? You're at 366. Okay, what if it drops 15%? Now we're looking at a little bit of a problem with the new bull put credit spread, which would be wider strikes, higher risk. May have been better off taking the small loss you took right now in that position. All right, let's go back. Let me close some of those windows down there. Let's go back to the main profit and loss chart to begin with. So you can kind of see where I'm going with these. The management techniques are great, and it's great to have those management techniques in your pocket, but they all have caveats and pros and cons. I go a little bit deeper to those in that full webinar, 8 ways to manage your bull put credit spread. It's not between the strike prices, and your net credit was so small to begin with. That's not bad. I don't mean that in a negative, Bill. You went for a very high 90, 91, probably 92% probability when you open this position. Small return of 6.4%, but hey, sometimes it's great to hit singles until those singles turn into home runs against you, which is what happens to you here a little bit. Maybe not a grand slam home run, but 1 or 2 home runs against you where it knocked down that position and probably previous wins that you had at this rate with that much higher probability and that 6, 7, 8% win rate. Okay, so pendulum adjustment. Just based on the net credit, I don't think it's going to work. What am I going to do? As I mentioned, I'd look to sell to close my 390. Keep 5 points. I'm going to swing it up to the 400. Okay, we're going to treat this like a little pendulum here. I'm just going to swing this out. I know the credit, the gain, the potential profit's always lower on the pendulum than it was on the initial trade. Unless maybe you shrink the strike prices, but you can't do that here, as we already talked about. So let's take a look at how that would appear doing the pendulum adjustment. Again, this is best used when it's between the strike prices, not at this point, but it might be a small profit or break even. So what I got to do, I got to sell to close the 390, buy to open the 400. I can tell right now this isn't going to work. It's going to be a negative. I'm sorry, the net debit looks like it's going to be greater than the difference in the strike prices. Yep. No, it's right there. But again, you see the reason why I wouldn't do this right now is because we saw something in the chart that it's easing off a little bit. Maybe the MACD is starting to go a little bit of positive from that decline. But you want the stock to be below your short put. So we just swung it out from our 390. Sorry about that curve drawing up here. That created the debit spread. So if the stock continues down, I can still make $20 in 20 days, only a 2% return. Not great. But at the same time, not the full loss or not taking more of the loss on the position. So, Bill, I think you did the right thing. Let me emphasize why just a little bit more. I need to find, oh, there it is. I need to find something here. Hold on one second. As we mentioned, you're not seeing anything I know on the screen. 235 is half of that max loss of 470. 185 that you took for the 470 loss is only about 39%. 40%. Let's just call it 40% even. Now, talked about where the trade was. We talked about why I didn't prefer some of the 8 ways, and we talked about even right here some of the pros and cons of trying the other adjustments. These aren't the only 8 ways. So these are my preferred 8 ways. You could create the butterfly position, do the short strikes right at the price where you're at to get a better break even, but then you're still going to have to manage one of the short options, meaning, do a bear call, but do it right at that 395 strike and buy a 400. Gives you much better premium, gives you much wider upper and lower break even, but you're going to have to manage one of those 2 short options because they're right at the same strike price. One of them is going to be in the money. One of them is going to have to be addressed. Knowing our previous conversations, Bill, I don't think that's your game plan overall. I'm going to go to RadioActive Trading.com right now. We're going to go into the Resources tab. And I want to go into the Trade Simulator tool. It's a very simple tool. I know you guys, some of you have seen this before. And what this tool does is allows you to just put in sort of your trading plan. What is my target return for the strategy that I'm using? What am I going to try to put my loss limit as when I go to close the positions? How much loss of what I'm putting into the trade am I willing to lose? What's my theoretical probability, or what is the success rate I'm expecting, my probability of loss here? And put in a starting amount and the amount invested per trade. Let's take Bill's numbers. He was looking for a 6.4% return. Let's call it a 6.5% return on his bull put credit spread. He stopped the position at our closing price right now in this trade. He might have gotten a different price, might have gotten better. We see $1.85 liquidation, which is 40%, 39.3%, 39.4% of the maximum loss of 470 on this trade. So let's just call it 40. Now, he was looking for a 90% probability, an 89.7% probability. So let's call his probability of loss 10%. If he's right 9 out of 10 times, keeping his losses to 40% of the max he invested in the trade, looking for a return of 6.5% and a 90% success rate, or only 10% probability of loss. And I'm actually going to change this to 33%. We're going to start with $10,000, and we're going to allocate $3,300 to each trade. Flip a coin 100 times. Heads, we win. We make 6.5%. Tails, we lose 40%. And we're going to look for a 90% success rate. Well, here with an 84% win ratio, at one point we look like we're getting ahead. With a series of wins in a row as we'd expect. Hey, we think we've got a great track record. We're up to 12,364, 24% gain roughly. But at one point, with the strings of losers coming up somewhere down this line in the 100 trades, you get down to 3764, down 63%, 64%. And at the end, you're still down 39% or so. Let's get to that 90. All right, there's 88. There we go. Still could be successful, 18% return. 94, hey, fantastic. Exceeded your expectation rate 94% of the time. You'd have a great winning record over time, even with that small return of 6.5%, but keeping the losses to 40%. So let me try to get right at 90. We're gonna stop here. 91%. 91% win ratio. assuming no management, but the management is there, just taking the 40% loss of the maximum that we had in the trade. At one point, we almost doubled the money to 20,717. We had a low value of only 9,056 and an ending amount after 100 trades, flip of a coin, not including commissions, we can include that later, of 19,295. Fantastic. 91% win rate. Let's put our loss limit up to 55 with all the same values and the same probability of win ratio. 83 is disastrous, almost went bankrupt. 91. Low value of 8185 compared to 9056. Not bad. Okay, still only a 10, 15, or 18% drawdown, 20% drawdown. That's not bad at all. This was a very large 9. Sorry, this is 9056 loss. The high value, with keeping the loss at 40%, with the same return of 6.5%, was 20,717. And the ending amount was 19,295. Yes, the strings of winners and losers are different. That does affect the outcome. But this is over 100 trades, a large sample size. That is a huge gap from allowing losses to go from 40% up to 55%. Now, there is a trade-off here. This goes back to what we were talking about with realistic criteria. There's also realistic management. You could come across and say, well, Mike, yeah, so just do better. Just keep your loss limits to 35% or 30%. Problem is now I'm not going to be getting this success rate. I'm going to be closing more winning trades sooner and won't get to this 90, 91% success rate. I'll be at 84, 83, 82. And as we saw, if I only have an 82, 83% success rate, of course, now it's not going to get me back to, there you go. I'm down about 42%, 50% at one point. That's why it's important to control the losses. You can't let it, let's say we go up to 70. Naturally, that's bad. Even at 91, again, it's like that first number we saw. You think you have a winning track record, but over time, you're setting yourself up for losses, 50%, 35% after several trades, because you're allowing the losses get too big. Now, through extensive testing, I know the other argument is the same. Well, Mike, if you're allowing 70% losses, half of the trades that you would have closed out, you wouldn't have, and they would have rebounded and become wins. That has never been my experience in actual trading or back testing, by the way. The trades that go against you still go against you and go against you fast, and they don't recover. So when I'm closing out at a 50% loss, most of the time, 99% of the time, 95% of the time, those trades still go further to the 70, 80, 90, and 100% loss if I hold on to them. They do not recover. Okay? I've never seen that played out where, oh, if you allow bigger losses, well, this is for bull put credit spreads in the structure I use, but if you allow more losses, you'll have more wins. If you allow for an easier stop, you'll have more wins. I've not seen that play out in the bull put credit spreads over time with the trades that I use. That 85% probability or higher 2 weeks out in time, the ones that go against you, and they don't come back. It's the same win ratio, whether I'm using a 70, 60, or 50% stop. And I use no stop, I still end up with the same success rate. Maybe it's a little higher, about 88 instead of 86. But the losses destroy the portfolio. They take it completely out to where there's no profit, even with that success rate. Mine is a little bit different. My average return is still around 14.5, 14.9%, keeping my loss limits to about 49, but really we'll just call it 50. And I'm looking for that 85% probability win ratio. And as you can see, yes, I'm going to take hits. I know I'm going to take hits. We're going to have strings of winners and losers. That's going to happen. But by keeping it controlled, you can still hit the targets you expect without. Sometimes this will drop down to 50% loss. But yeah, there's one. It's 80-20, but I need, I'm usually 84 to 86% success rate in the right market. Sometimes I'm not trading bull puts at all, believe me. When the market sentiment showing bearish signals, I'm not in bull put credit spreads. But when we do trade them, that's what we typically see. But as always, if I allowed it to go to just a 65% loss with the same values, hey, that's perfect, but that's almost a 90% win rate. Here's just about what we saw, but with a lower ending amount. When it gets like 86, I want to get to, yeah, 85. Still good, but not near as what we were expecting when we controlled the loss to 50%. And I'm still able to keep that 83, 84, 85% win ratio with the 50% stop, and haven't seen it really improve by letting the risk go to 65 or 70. The only thing that it does is damage the end result. All right, so that's what I wanted to reinforce, the 50% rule there, which reinforces also, again, unfortunately, what? That in this scenario, a dozen things could have been done. 20, 30, 40 different things could have been done that we didn't discuss. And we already spent a good amount of time on this, almost 40 minutes on this, I believe 45 minutes almost on this. But again, from what we discussed before, in this case, Bill, I think these two were the right move. You know the risks that came with this one. You didn't want to take it. This was not available. We talked about the caveats with this one. You didn't have a strong sentiment that it was going to recover, which also sort of negated these two adjustments because you didn't have that strong bearish sentiment. This one helped a little bit and could still work out to be a higher profit, definitely. But it didn't address the loss to the downside only by 20, 30, or 40 cents. Pendulum adjustment, this is not the time to use it. So in essence, I think you made the right play. You kept the loss below 50% of the maximum loss. I believe you could have done nothing as well. These other ones, you didn't have a strong enough sentiment, I feel, to make that happen. Okay, and that's why that's why I think he did the right thing. And it's probably what I would have done. As I mentioned, as we're looking at the stock chart there, I'm not sure if I would have done it this early either, maybe here. But when we saw that the loss here today is not 50%, it's only 40 cents. So I might not have been at the 50% loss here, but I was definitely thinking about management techniques at this time, the day after you enter the trade. But here, I cannot fault what you did, although there are ideas out there and other things you could have done differently and so forth. I think you made the right choice. It's the choice I probably would have made in this scenario, to tell you the truth. Okay. I do have one last question that came in, but I want to look at something else real too, so I can. I appreciate that. Chuck says, in my opinion, this has been one of the best sessions ever. Thank you, Chuck. He says you're like a good quality cheese, getting better with age. I appreciate that. And Raymond says, that is great from earlier. All right, but Raymond does have another question. Before we do that, I'm just really curious. What am I doing? I'm going to bull put credit spread. My apologies, folks. And I don't think you're looking at the right screen. No, you're not. Hold on. What I want to do, I want to just see foot and mouth, right? So I mentioned, the spreads that I would do following the default search on Power Options. I want to go to Smart History. I'm going to go to both the 8th before the 11th and look at my weekly bull put screen. This might take a second because we're uploading all the historical data in the background, so it takes a moment to interact with the tables that are being interacted with a large memory dump of data, options, and stocks. So what I want to do here is I just want to see the bull puts that would have matched on September 8th and the close on September 11th. Because I mentioned Netflix was above the 20-day moving average, likely on the 8th and then the 11th as we saw, and at the same time, it was on the 11th also. So on the first results, now we've got Coinbase was in there. Lululemon, there is a Netflix. It's a 412.50, 410. So that was for the 22nd of expiration. That's going to be a loss. So now I'm going to calculate the group results. I just want to see what happened here. So I'm not saying this is ironic, but this is kind of funny because I would have taken the top 3 on that list, and Netflix wasn't on the top 3. The top 3 or 4 here: Alphabet, Super Micro, Generic. I'm sure Alphabet got hurt too. ServiceNow, maybe Carvana. Again, it's interacting with the data. Why do I say foot and mouth as well? I wanted to see if there was a Netflix one that matched my criteria for the defaults, and there was. And there we go. Yep, this one's taken a little bit of a loss, 249.46. It's just at the 1% rule. This other one here, 570. It's at 579. Nope, it's not at the 1% rule yet, but it's at a loss. But the other one's already at a 26% gain, 4% loss. I don't want to see it. Yep, Netflix, 86.8%. Let's put us way down the list. So still another week to go. I'm sorry, still another 14 days to go on these. 13 out of 50, 50%, 5.8%. Now let me run it on the 11th, because normally that's what I would have done. I normally open my new trades on Monday following the previous expiration. See, I'd be at a loss right now, 5.8%. That's on all those trades. It would have taken the top three, but it looks like it would have been the average. That one 26% winner, the 35% loser, the 4% gainer. So that probably would have balanced out. Usually I'm only in about 3 or 4 trades at a time. But let's look at September 11th. See the top results there, and then do the same exercise also. Then we'll get to that question. Chipotle, Alphabet, Tesla, Workday, K-Lot 10 Court. Nope, it's not in the first 30 results. Okay, so that doesn't mean anything. So these would have been also for the 22nd of September, 11 days out. We've just been in the trade for the first 5 days or so, from September 11th, Monday, to today. Again, average returns 14, 13.6, probabilities 92, 86, 86. And the first two are doing okay. Third one's not so good. Fourth one's not so good. I probably wouldn't have made it to the fifth one. I might have. But again, not doing so good. These bottom ones have all been hit. What are they all? Anet, Team, a lot of tech in there. What's this big loser? ACN, okay. Roku, Airbnb, that's not too bad. But yeah, still a couple 11 days to go if I would have done this, these trades here. But I just wanted to show that because nothing's infallible. But again, I just was curious to see if Netflix matched on the Friday, the 8th. It would have, but it wouldn't have matched the criteria at the close on the 11th. Bill might have found this using that search. But again, that return was so low, I don't think it would have matched the criteria because the minimum return is 9%. So that 6.4% when return. You might have got the idea from Netflix from that search, but gotten a more conservative position. But again, I didn't see it here on the 11th. I only saw it, might have been in there during the day. But hey, I just wanted to show that this is our best foot forward. Doesn't mean it's always the best market to enter into those strategies. You got to be careful with that as well, and always practice proper position sizing.